So this failure system is a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they tried to sort it out? I mean, the problem with this is that, of course, we're not just talking gold and silver. We're talking about virtually the whole of the CME shutting down. Also worth noting that from January the 1st, China is banning the export of silver. Now, that's interesting because China has been, in my view, the swing factor in controlling prices in the West until very, very recently. So if they're withdrawing from the market completely, there is no lid on silver, none whatsoever.
Something is happening beneath the surface of the global financial system, something the public was never meant to see. For decades, the Western paper markets have acted like the pressure valve for gold and silver, controlling price through derivatives, rehypothecated supply, and synthetic volume. But today, that structure is starting to show cracks so deep that even the institutions built to conceal them can no longer hold the line. In every major precious metals market, from London to New York to Shanghai, the signals are converging. Real metal is tightening, paper positions are failing, and the physical market is beginning to assert dominance in a way we have not seen in the modern era. The first red flag didn't come from Wall Street, it came from China. Beginning January 1st, Beijing is banning the export of silver, a move with implications far larger than the headlines suggest. China has been the quiet swing factor for silver prices in the West, supplying just enough metal to keep the system balanced. With those exports now frozen, the last informal pressure valve on the LBMA and CME is gone. A lid that once kept volatility contained has been removed, and there is no mechanism left to replace it. When the world's largest industrial consumer and one of its largest producers withdraws from the market, price doesn't adjust gradually. It dislocates. And right on cue, the Western exchanges began to wobble. Not with a modest backlog or a delayed report, but with something far more suspicious: an unexplained shutdown of critical CME data infrastructure at the exact moment a massive stand for silver delivery was underway. In a market that relies on confidence, opacity is the greatest tell of all. When data disappears, you can be sure something deeper is at risk, something the establishment cannot control, cannot hedge, and cannot roll forward. In today's video, Alasdair Macleod breaks down the scale of what's unfolding and why this may be the beginning of a structural break in the derivative markets themselves. Later in the video, I'll show you how silver's role as a monetary metal is reasserting itself exactly when fiat currencies are losing the last pillars of support they once had. If you find this analysis valuable, make sure you subscribe and share this video, because the mainstream financial press will not touch these developments until it is far too late. I appreciate the support and hope you enjoy the video.
Silver, there's no doubt about it. There is a liquidity squeeze. And in fact, in both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. There's obviously a little bit, but I mean, it's tiny. If anything, I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that, particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement, because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events, silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought.
If it's not retail buyers taking this thing up higher, who is?
Well, this is the point, Danny. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets. And there was, actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver. And I reckon that's going to tip the market up, or whatever I say, but you can see how the rumor might start there.
Yeah. And
confirm, if you like, that it's Chinese sources who actually went for it. But the other thing that's fascinating is, was it just coincidence that a data center had to shut down because it was overheating? Now, I read somewhere by someone who is supposedly an engineering expert on cooling systems that data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system is a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they try to sort it out? I mean, the problem with this is that, of course, we're not just talking gold and silver. We're talking about virtually the whole of the CME shutting down, if you like, by either having the plug pulled or through a data system fault. So it's all very mysterious. It really is mysterious. I mean, what I would say is that one of the primary functions of the system, the establishment, is to ensure that if something like this goes wrong, we are not to know about it at all. They will sit on it. They will claim anything to ensure that it doesn't leak out into the public that someone is in trouble. Because if someone's in trouble, we start worrying about this, that, and the other thing. I think we're probably beginning to do that anyway when we see the stands for deliveries. I mean, I haven't actually, ahead of this, looked at my numbers, but I think we're looking at what 12,500 tons of silver this year, 12,500 tons of silver this year, and roughly 1,200 tons of gold. I mean, these are huge numbers. The COMEX has turned out to be the largest precious metals mine in the world. 3-4 times the largest mining nation. This is a staggering development.
What happened to that $2 billion order? Did it get fulfilled?
Well, no, it was a stand for delivery. Basically, someone bought the December futures. It's all on the December futures. And instead of closing the thing out and rolling it into the next one, which is normal practice, if you like, they said, right, come on, we want that stuff. Deliver, as they have the option to do. This is an extraordinary thing. It doesn't necessarily leave the CME warehouses, but the point is that the ownership changes and it goes into firm hands. It's no longer available as liquidity in the market, being registered for delivery. Comes out, that's it. Tough. And in London, of course, there's no liquidity at all, which is why there's been that backwardation.
What Macleod describes here isn't just a squeeze, it's a structural inversion. Silver and gold are rising while speculative interest is collapsing, which means this rally is not coming from hot money or leverage. It's coming from the forced unwinding of short positions, the exhaustion of synthetic supply, and the refusal of physical holders to re-enter the market at any price currently offered. A system that once relied on layers of paper promises is suddenly being asked for metal, real metal, and the institutions that built their dominance on liquidity illusions are discovering the metal simply is not there. This is why the data fault on the CME is so consequential. A $2 billion stand for silver delivery does more than expose weakness. It exposes the reality that most registered silver in these warehouses exists only in accounting terms. When ownership changes hands and bars move into long-term, non-circulating custody, the system loses elasticity. Liquidity evaporates. Every ounce transferred from registered to eligible removes the buffer the derivative market relies on to maintain pricing power. Once that buffer disappears, the paper market no longer dictates price. The physical market does.
Who's the kind of person or entity that would stand for deliver to the tune of $2 billion in silver?
Well, I mean, in China, it could be a speculator. I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. Mm-hmm. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and proper. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move it's rather like, when you get a dislocation in the market, the price just goes crazy. We saw this with nickel on the LME, was it 18 months ago? In that case, it wasn't a shortage of nickel. There was a shortage of deliverable nickel because the nickel had to be delivered, if you like, in accordance with what was required under the LME contract. And it was a Chinese nickel business which had loads of nickel, which it could have delivered, but not in that form. So it reneged on the contracts. And of course, the LME then had to sort of strike out any contracts that were taken out over that period. In the case of silver, it's different. It's not there. It is not there. It's gone. It's as simple as that. And of course, the other thing is that any industrial entity which has got a stockpile, is it going to let it go? In the past, it might have traded a bit, but under these circumstances, oh no, certainly not. We're going to hang on to our silver because we won't get it back if we put it into the market. So it's almost become it's a Giffen good. I've written about this a few times. A Giffen good is one which sort of upends the normal supply and demand relationship being sorted out by price. Price rises and, supply increases as a result. No, what's happening is that as the price rises, the supply is diminishing. And that's having a catastrophic effect as far as industrial users are concerned. And of course, it's only just beginning to catch the attention of people in the markets who are sort of thinking, should we speculate by buying silver? Should we buy silver ETFs? I mean, we saw Indian ETFs suspend operations back in the beginning of October because they couldn't get any metal. You could easily see the same sort of thing happening with ETFs in the West. SLB and so on and so forth. They may be forced to do that. I don't know. There's just no silver. I think that's the point, Dan. The spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it and, premiums and things, we can trade this. They're not doing it because there isn't the liquidity to do it. Because, if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied directly to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock, short it, not short it, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on, which is one reason why I'm not at all keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, I mean, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. I mean, if derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market. I think the answer to that, I mean, I've been watching, in London, we've got the largest silver mine in the world, actually, Fresnillo, listed on the London Stock Exchange. And it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price. It's behind the silver price most of the time. And it maybe catches up a bit the next day. The idea that correlates quite well with the silver price, the idea that investors looking to buy or sell Fresnillo, SLB or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying, silver's the game in town, we've got to go for it, we're going to buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like.
So there's a lag involved when it comes to the mining stocks.
I think there's a bit of a lag. And I mean, basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying, silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver, and I've just explained why the market is short, etc., and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers.
What Macleod outlines in this final segment is the part most analysts still refuse to acknowledge. This is no longer a story of retail enthusiasm or speculative mania. There is nothing irrational about what's happening. This is industrial demand colliding with geological scarcity, sovereign accumulation, collapsing inventories, and a derivative market that has stretched its promises far beyond its capacity to deliver. When industrial users begin hoarding instead of selling into rising prices, you know the game has changed. When ETFs suspend creations because they cannot source metal, you know the game has changed. And when nations like China begin locking down exports while simultaneously standing for delivery in Western markets, you know the end game is no longer hypothetical. The silver market is transitioning from a commodity framework to a monetary framework. The price action is no longer governed by futures curves or speculative flows. It is governed by the availability of metal. And as Macleod makes clear, once the market realizes silver is not merely scarce, but structurally unobtainable, the revaluation will not be incremental. It will be violent, disorderly, and irreversible. The paper era is ending, and the physical era is beginning. If you found this breakdown valuable, share this video with someone who still thinks silver is just another commodity. Subscribe for deeper analysis and stay tuned, because when a market that underpins global industry and monetary history hits a true supply wall, everything priced in today's fiat system will need to be reevaluated. Thanks for watching, and see you in the next one.